Hey, this is June from Turning Point Life Investment, and this video is for the week ending in February 28th, 2009. So we ended another calendar month, and as always, we always want to take a step back and look at what happened this month on a 10-year monthly view, just to give us an overall big picture of the overall trend. Okay, so the trend still down. Okay, pretty obvious. We actually made a new low past the November low. Okay, so support has been broken. The bears are still back in the game. They're taking this market lower. Only question is, how low can this market go, right? So right now we're pretty much right at the 2003, 2002 lows. As far as SPY is concerned, I know the SPX is a little different. It's a little more bearish, but right now we're right here at the 2002, 2003 low. Now, once it breaks, it's anybody's guess as far as how low the market can go or where it's going to find support. We can go all the way back to the 90s, 97, 96 to look for potential support, but I don't find that as credible, only because, well, it's over 10 years ago. The reason why I say it's not as credible is because, well, you have to think of why or how support is being built. Support usually being built is based on emotional buying, emotional selling. I would see it more credible if it's more recent, for example, back in November or even 2002, 2003. But if you're talking about an event that happened over 10 years ago, people aren't as emotionally attached to those levels as levels currently. Okay, so we could look back in the 90s and look for potential support levels, but I wouldn't put so much emphasis or so much weight on those levels, only because, like I said, it's not as recent. The data isn't as recent as back in November or back in 2002, 2003. But overall, as far as the trend is concerned, you can see how we're getting very stretched out with the moving averages. Okay, so we've never had that condition before, at least not within the last 10 years. So it's telling us that we're getting pretty stretched out. And on a monthly view, stochastic is showing, or it's heading towards the oversold area. So overall, the trend is still present, it's still alive, but it's getting a little bit tired. It's getting a little bit stretched out. Okay, so even though we're not at the bottom yet, but we're starting to approach there, only because we're starting to get really stretched out and really oversold on a long-term monthly view. Next, we go into a 3-year weekly view. We have pretty much 3 consecutive down weeks, this week making the third week on relatively decent volume, at least above average. As you can see, as far as stochastic and MACD, it's telling us that there's some pretty strong downside momentum. It's not showing any signs of weakness or reversal yet. But I mentioned within these last few videos that this leg down is going to be a relatively weak leg, and usually the last leg is going to be weak. Only reason is because, well, let's take a look at the MACD for a second. In order for the MACD to show convergence or strength within this current leg down, that means that the MACD has to surpass this level in order for it to be converging, which I kind of find it's going to be a little difficult for the MACD to pass this level with this current leg. So if that is the case, we're going to show some kind of divergence with the MACD, once again indicating weakness. Okay, so obviously we have to wait for the next few weeks to find out exactly what the MACD is going to do, but more than likely we're going to see some kind of divergence which indicates weakness in this last leg lower. Okay, next we go into a 6-month daily. So on Friday, we actually managed to close underneath 74, just barely, just a hair underneath 74. So on volume, you can see it's picking up. Okay, so selling pressure has definitely increased. On a daily, we are a bit oversold on stochastic. So on a daily view, I would be a little cautious on shorting this market as far as right now, within this next couple of days, only because we are a bit oversold. A safer play would be if the market does drift a little bit lower, for it to come back and test this as resistance. Remember what I keep saying, broken support usually becomes resistance. So if the market does drift lower, wait for it to come back, test either the 74, 75 level or this 20-day moving average. If that fails to break above it, then that's a safer play to be shorting the market as opposed to right now. So as far as potential support, I would say 70, only because it's a nice round number. People usually like to remember round numbers. So those make great support and resistance level. 70 will probably be the next target that I would shoot for as far as SPY is concerned towards the downside. and upside resistance, like I mentioned, around the 74, 75 previous support, and as well as this 20-day moving average. Okay, let's go into the VIX. Here we go. So the VIX is showing that it's still sideways. Okay, pretty incredible. We're not getting the same amount of fear that we are experiencing back here. And even the VIX is showing a bit of divergence, bullish divergence, only because, well, if everything corresponds accordingly, then we should be up here in the VIX because that's where the market is back in November. But we're not right now. We're actually going sideways. So the amount of puts that are being bought by traders aren't as dramatic as they were back here. Once again, pointing towards a sign of a last leg in this current move to the downside. You can see how even on a current view, you can see how even though the market has made a new low, the VIX hasn't exactly moved that much at all. Okay, so once again, right, pointing towards some kind of divergence with the VIX to the market. Okay, next I'm going to go into gold analysis real fast. I mentioned last week to be a little cautious in adding more longs, only because we're at the all-time high. Let me go to a 3-year view. I'm using GLD, so all-time high around 100. So we actually didn't get to tag 100, but we came pretty darn close to it, right? 99. And I said to be a little cautious, to add more positions or at least take some profit. And this week we had a down week. Okay, so once again, right, this is why resistance and support levels are so critical to look at, because, well, they don't lie. They don't tell us, or at least they tell us when to be cautious and when to be more aggressive. Okay, so right now it's telling us to be a little more cautious towards the upside. Now, does this mean that you should go and short this market? Absolutely not. Only because, well, it's still in an uptrend. Okay, this uptrend is still valid. It's not showing lower lows and lower highs. As far as prices, we did manage to pull back towards the 20-day moving average. The only question is, will this hold? Just like how we hold here. Okay, if not, then look for support at the 50, similar to what happened here. If this breaks, then we're going to have pretty much lower lows and lower highs, which by definition is the start of a new downtrend. And if that is the case, then I would no longer be bullish on gold anymore.